Thank you. It's a great pleasure to be here and an honor to be asked to speak at this event. I have a special fondness for Canada. I spent a year at Simon Fraser University, where I completed a master's degree in 1968. In fact, I visited Niagara Falls in 1967, that's a few years ago, and then drove across the Trans-Canada Highway to Vancouver. So it's great to be back in this area. Now, I'm going to take what looks like a little bit of a digression to start with, because I want to put the economic situation in context. So my digression is about Europe. A couple of weeks ago, Mario Draghi, who is the head of the European Central Bank, spoke at the Brookings Institution about his view of monetary policy and his perspective on the future of growth in Europe. The euro area is currently stagnant. Germany, France, and Italy are actually declining. He believes, or expresses the belief anyway, that growth will resume later this year or in 2015. I think that's uncertain. He's clearly frustrated. Monetary policy is being asked to do more than it is able to do to revive growth, and he wants those countries that have what he calls fiscal space to increase spending, particularly on infrastructure. It was clear to everyone in the room he was talking about Germany. He wants Germany to do more to help the rest of Europe. So a lesson here for all of us is that I think the global economy is short of demand. We don't have enough spending to really push on the resources side. So growth in the United States, in Canada, in Europe, in Japan would be stronger if we could get more demand going. So that's the first point I want to make, and it does, I think, condition a little bit some caution on stepping on the fiscal brake. It may be necessary, Ontario. I'm not an expert on your budget, but if you are going to step on the fiscal brake, do it carefully, do it as slowly as is reasonable with where you have to get your goals. Well, even in comparison with Europe, another reason I mentioned Europe is, I guess, misery likes company, and things are better here in North America than they are in Europe. We've come through this difficult crisis, I think, in better shape. Canada avoided financial crisis and had the good sense not to buy too many bad debts from the United States. At a recent dinner in Washington, the North American CEO of a leading German company, and I'm not mentioning his name just because it was an off-the-record dinner, he said he was asked for his perspective on the global economy and was pretty clear. North America, specifically Canada, the United States, and Mexico, he felt were the best and safest countries for investment. So I think comparatively speaking, North America does look good. Now, as I say, that's relative to Europe, which is weak, relative to Japan, which is weak, but still. Somebody made a joke about being the best horse in the glue factory. I don't think we're quite that, but we certainly are better off than some of the other advanced countries. The economy in the United States, having said what I just said, is still not good. It dropped like a stone in 2008 and early 2009. Millions of workers were laid off, and unemployment soared to 10%. And the recovery since then has been weak. Real GDP growth from 2010 to the present has averaged only a little over 2%. And this is in contrast to the kind of strong recoveries that we had after earlier deep recessions back in the 70s or the 80s, and certainly weak compared to the strong growth that was achieved in the 1990s when Bill Clinton was in the White House and I was in the White House too. Those were good times. Unfortunately, we're not getting that kind of growth now. Now, unemployment has dropped. It's actually dropped a little bit below 6%, and that's a good thing. But this actually is mostly because of a decline in the rate of labor force participation. We've got fewer people looking for work. Some of this is natural. It's the result of the baby boom generation reaching retirement age. But there are also many discouraged workers that have given up looking for jobs. So I think we have a problem on the labor market side. Many of the things you were talking about here apply equally or even more so. In the US, there's a shortage of labor skills. We have concerns about our education system. Yes, the best schools in the United States are world leaders, but K through 12 is not good in a lot of locations, and young people don't always have the skills that they need. So I think we have a lot of serious problems there. So why has the recovery been relatively weak? And I think both demand and supply factors are at work. I'm sorry, I'm an economist. I talk about the usual economist cliches of demand and supply, but I think they are the things I need to talk about. Demand growth has been sluggish because after housing construction collapsed in the crisis, nothing really has replaced that source of demand and of jobs. Consumers have been cautious in their spending, naturally. They became very indebted. The value of their houses dropped, and while it's coming back, it's still not where it was. But the housing sector in the U.S. still remains really quite sluggish. It's growing, but if you look at where we were, not where we were in the boom, but where we were in more normal times, we are not back there at all. And we just don't seem to have had anything that's replaced that. As I say, consumer spending has been okay, but not great. We had a stimulus in the early part, right after the recession, but in 2012 and 2013, fiscal policy was actually somewhat contractionary with both tax increases and spending cuts, so that's been a bit of a dampener on growth also. Business investment is okay, it's growing. You mentioned that there's some momentum there, which I hope is right. We are seeing a little bit of momentum on investment side, but it certainly hasn't been enough to close the demand gap. Auto sales have been important, really both because of the direct demand effects of strong auto sales, but also what they've done for sort of steel demand and machinery demand. I was talking last night and someone was telling me that Canada hasn't necessarily benefited from that growth in auto sales in quite the same way because of the exchange rate having gone up, causing some migration of production either to Mexico or to the United States. Now, some of the things that I think people are concerned about, there is a worry, particularly among the business community, that one of the reasons for the slow recovery and the slow growth of both of investment is regulation. There's a lot of talk about regulation. There is more regulation. Certainly, we've had the Dodd-Frank law, which has, I think, affected the ability of banks to make loans. I talked at a meeting we had at Brookings with the CEO of U.S. Bank, one of the big regional banks. He said, we're really no longer doing risk assessment. We're not really assessing loans the way we would in normal times. We're really just looking over our shoulder to see what the regulators say and whether they're going to approve those loans. TD Bank, your own Toronto Dominion Bank, which operates in the United States, the CEO made some similar comments the other day in a publication that I read. So there is concern, I think, that the level of regulation, concern about what environmental regulations are going to be brought in, and I'm a supporter that we have to do something about climate change, but the question is how you do it and how much uncertainty you create around how you do it. So as the U.S. economy gradually approaches full employment, I said the recovery is sluggish, but we're now, many years into that recovery. We're getting to the point where we're getting closer to full employment. The supply side of the equation becomes more of a limiting factor, and there's some weakness here too. I mentioned slow labor force growth, but we've also had slow productivity growth. Again, misery loves company. I know that productivity growth is a concern here too in Ontario. In fact, I actually felt a little bit better after reading about Ontario, since even though productivity growth is slow in the United States, actually a little bit faster than in Ontario, which I'm sure doesn't make you feel better, but I felt a little relieved. What we've seen in the pattern of productivity in the U.S. is that we had rapid growth after World War II all the way through to the early 70s. Then productivity growth slowed down for about 20 years or so. And then we had a surge of productivity, which most people feel was associated with the production and investment in high technology goods in the 1990s. But that has slowed down again, and productivity has slowed down, really back to the pace of the 1970s and 80s. So that's some of the bad news. There is some good news in the U.S. economy. Despite dire warnings about expansionary monetary policy, inflation has remained low. In addition, the federal deficit, which exploded in the recession, has declined sharply. It's now down to 2.8% of GDP in the fiscal year just ended. And that's down from more than 10% of GDP that we had in the worst of the crisis. The third good news, I think, for the U.S. has been an energy revolution generated by fracking technology, which has pushed up first natural gas production and then oil production. Given that global demand for energy has been fairly weak, this has pushed down oil and gas prices. That's good news for consumers, both in the United States and I think here in Ontario. Obviously not such good news for energy producers, including some in Canada. I'm sure those prices are going to go up and down. Supply will weaken as the price goes down, and then it'll go back up again. That's the usual cycle. But I think overall, the increase in the supply in North America of oil and gas is, I think, good news for all of us. And some of these new technologies obviously are being used in Canada, increasing the supply of oil from the tar sands and other places. And finally, the other piece of what I call good news, but I'm going to qualify this in a second, is innovation. Innovation is very hard to measure. I have, over the course of my career, tried to measure it. It's tough to get a handle on. It does appear to have been that there's been a continuation of the rapid growth, at least in electronic technology or the social media stuff that comes with that. San Francisco, in fact, is very much a boom town again. I don't want to take my own time away, but I can't resist a quick observation. I was at on a technology panel in San Francisco not too long ago, and then I watched last night the great presentations from the group here, and I thought there's one big difference. In San Francisco, the tech entrepreneurs looked like they just sort of slept in the clothes that they're wearing, and they got up and came to the presentation, whereas here everybody's wearing a tie. I assure you, you'd be excommunicated in San Francisco if you wore a tie. I'm trying to keep up the standards here myself. But the flow of this technology, I think, it creates kind of a paradox that I want to address. The economy is changing, clearly. We heard that last night. We hear that all over the place. Companies like Google and Facebook, which didn't exist a few years ago, and now they're worth billions, hundreds of billions. There really is a common theme. The world is changing fast. At the same time, what I just described in the U.S. economy is the growth is sluggish and slow. I could also point out that wages and median incomes have stagnated or even fallen over time. There are people, Larry Summers, who I worked with in the Clinton administration, is talking about secular stagnation. His view is that we're going to have a perennial difficulty getting demand growth to be adequate to sustain full employment. Another well-known economist in the United States, Robert Gordon, argues that really innovation is dead. So how do we sort of square this strange circle? What do we make of this paradox? Well, I want to express a little humility. This is hard. I don't know the answer to this, but let me try to say what I think I see on this. I think Robert Gordon is wrong. I don't think innovation has ended. I think that's an absurd notion. But maybe to take something out of what he says, the nature of innovation may well have changed. It's not quite the same. And again, it's a question of seeing how this plays out. But let me say why. Tech companies today, like Google, Facebook, Apple, and the others, really are changing our lives and creating hundreds of billions in wealth. But their level of employment is pretty small, and the amount of investment they generate is modest. It's not zero. Google builds a lot of server farms and so on, but we really aren't talking about General Motors or ATT in the 1950s. This is a different kind of world that's not generating the same level of employment. Even an Apple, for example, we think of as they make iPods and iPhones and so on, but they don't really make them in North America. They're made. They make the profit in the United States, so they do the design in the United States. The manufacturing is done overseas. So there really has been a change, I think, in the way that innovation plays out in generating jobs kind of across the board. So what we have, particularly in the US and maybe here too, is lots of kind of relatively low-skill, low-wage jobs. We also have a lot of high-tech, high-skilled jobs, a very strong demand for talent at the top, but that decline of jobs in the middle, which is something that I think many people have talked about. I was reflecting, I love Uber. I can call up and get a taxi. I'm running out of time already? Okay, let me not give my story about Uber, but say a little bit about what I think. Give me 2 more minutes. We did start late, as I recall. Let me say a word or two about, what can we do to try to stimulate growth. Well, first of all, I thought the report that you prepared for this summit was very good. So I thought you got a lot of the right answers there, and I congratulate you on that. I would like to give you a validation on that. My own list, so to speak, is number 1, I do think global demand needs a shot in the arm. I don't know that Ontario can do much about that, but you do have to recognize that you are in an economic environment where there's still a lot of weakness, and we may not get back to a stronger period for a while. The second thing I'd want to mention comes out of a McKinsey study, as was mentioned. I work with the McKinsey Global Institute, and they have a report that you can find on their website called Game Changers, and I just wanted to mention what their 5 game changers were. One is shale oil and gas. The second is improved competitiveness in knowledge-intensive industries. The third is big data and the application of new technologies. The fourth is infrastructure, and the fifth is talent. So again, looking at the report you wrote here, there's a lot of overlap there. Shale oil and gas may not be so relevant for Ontario. I think most of the others are. I think on the competitiveness side, you are perhaps now seeing movement of the exchange rate in the other way, which creates more of an opportunity. One of the important things that came out of that McKinsey study for the U.S. was that the U.S. is running actually a trade deficit in knowledge-intensive goods, and that's very odd. That's not what other countries do. Unfortunately, Canada wasn't in our list. We compared it with Europe and Japan, but that's something I think you need to look at, and maybe also a concern in Europe. You need to improve competitiveness in knowledge-intensive goods because trying to do, you can export resources, natural resources and oil, but you don't want to be in simple goods, labor-intensive goods. That's not a good place to be. Germany is a good example of a country that has continued to be a strong exporter, even though it pays high wages. Their workers work short hours, and yet at the same time they've managed to be a strong exporter. So that's a good country to look at. There is this question about regulation, and I'll make that my last point. I can bring some other stuff up if there's questions, which I hope there are. One of the things that we found at the studies that the McKinsey Global Institute did in the 1990s was the importance of both maintaining competitive intensity and having the right regulatory structure in order to do that. So that as we compared across countries, if we looked at the United States, the UK, Germany, Japan, and we asked why is the auto industry in one of these countries more productive than the other? Why is retailing more or less productive than in another country? It often is the structure of regulation and the impact that may have on the degree of competitive intensity that companies face, which drives that productivity. So there's been quite a lot of emphasis, and correctly so, today in the things you've talked about new companies, small and medium-sized enterprise, and I agree with that. Those are going to be the sources of growth. But if you want to improve productivity in sort of the big existing companies, you have to make sure that they have their feet to the fire, as it were, that they are facing competition against best practice, which forces them to become best practice and also forces them, I think, to look for ways to innovate so that they can stay on that frontier. All right, well, you've executed me, as it were, but I'm very happy to take some questions. Thank you.